Ever wonder why the traders posting their massive wins on social media always seem to disappear after 6 months, while the boring, cowardly traders you never hear about are quietly building generational wealth? Today I'm going to destroy the most dangerous myth in trading, that big risks create big rewards. Here's what every trading guru won't tell you. The market doesn't reward heroes. It slaughters them. The aggressive traders taking massive positions, the revenge traders doubling down after losses, the diamond hands crowd refusing to cut losses. They're not brave, they're statistical certainties for account destruction. Meanwhile, the traders everyone calls cowards, the ones taking tiny positions, cutting losses at 1%, sitting in cash for weeks, they're the ones actually making money. Real money. Consistent money. The kind of money that compounds into life-changing wealth. Professional trading firms don't hire heroes, they hire cowards. They want traders who are terrified of losing money, obsessed with capital preservation, and bored by consistent small wins. Yet every YouTube channel, every trading course, every social media influencer is selling you the hero narrative because it's sexier, more exciting, and easier to market. We're going to examine the brutal mathematics of heroic trading versus cowardly trading. We'll look at the neuroscience research showing why aggressive risk-taking literally rewires your brain for failure. We'll analyze real account statements comparing heroes and cowards over multiple years. Most importantly, we'll explore what happens to your psychology, your account balance, and your family's financial future when you choose courage over cowardice in the markets. Because here's the uncomfortable truth that no one wants to admit. In trading, cowardice isn't a character flaw. It's a survival skill. The market rewards paranoia, punishes confidence, and absolutely destroys anyone brave enough to bet big on being right. Today, you're going to learn why every successful trader you've never heard of is a coward, and why embracing that cowardice isn't just the path to profitability. It's the only path that doesn't end in financial ruin. Scroll through any trading social media feed right now. What do you see? Screenshots of $5,000 days, $10,000 wins, traders posting their massive positions with rocket ship emojis and diamond hand hashtags. These are the heroes, the legends, the traders everyone wants to be. Here's what you don't see. The same traders 3 months later when their accounts are blown up, when they're asking for loans, when they've quietly deleted their social media presence and gone back to their day jobs. The platform algorithms don't show you failure. They show you the exciting wins that keep you scrolling. This creates the most dangerous illusion in trading. That success looks like heroism. That real traders take massive risks and post about their wins. That if you're not risking significant money, you're not really trading. It's complete nonsense, but it's incredibly seductive nonsense. Think about every trading course you've seen advertised. They all show the same thing. Massive position sizes, huge percentage gains, traders living lavishly off their supposedly massive profits. They're selling you the hero narrative because heroes are exciting. Heroes get clicks. Heroes make great marketing material. But here's what's really happening behind the scenes. The traders making real money, the ones building actual wealth, the ones still trading 5 years later, they're invisible. They're not posting screenshots because their daily gains look boring. $200 here, $500 there. Nothing worth bragging about on Instagram. These successful traders look like cowards to the outside world. They're taking tiny positions. They're cutting losses quickly. They're sitting in cash for weeks at a time, waiting for the perfect setup. They're doing everything the hero traders mock as weak and timid. Yet they're the ones with 7-figure accounts. They're the ones paying cash for houses. They're the ones sleeping well at night instead of checking their positions at 3 a.m. in a cold sweat. The market has created the perfect deception. It makes losers look like winners, and winners look like losers. And until you understand this fundamental truth, you'll keep chasing the hero trader mythology straight into account destruction. Let me introduce you to two traders. Dave and Emma both started trading at exactly the same time with exactly the same account size, $50,000. Same broker, same market access, same opportunities. But their approaches couldn't be more different. Dave is your classic hero trader. He risks 5 to 10% per trade because anything less feels like he's not really trying. When he wins, he posts screenshots on Twitter. When he loses, he doubles his position size because he knows he's right, and the market is just being irrational. Dave has 4,200 followers who love watching his roller coaster ride. His trading setup screams success. Multiple monitors, expensive charting software, a standing desk because sitting is for weak traders. He's always in a position because cash is trash, and opportunities are everywhere. When other traders talk about waiting for setups, Dave laughs. The market moves every day, so why wouldn't you trade every day? Emma trades like she's terrified of losing money, because she is. She risks 0.5% to 1% per trade maximum. When she's wrong, she cuts losses immediately. No questions asked, no hoping for reversals. She'll sit in cash for 2 weeks waiting for a setup that meets her criteria. Her followers? 37 people, mostly her family. Her trading setup looks pathetic compared to Dave's. Single laptop, free charting platform, platform, trades from her kitchen table. She's in maybe 1 or 2 positions per week, sometimes none. Other traders would call her approach boring, timid, maybe even lazy. Here's what's fascinating. Dave feels like he's crushing it most days. Even on losing days, he's taking action, making moves, being a real trader. Emma feels like she's barely participating. Her gains are small, her activity is minimal, her results look insignificant compared to Dave's dramatic swings. But here's what neither of them realizes yet. The market doesn't care about feelings. It doesn't reward excitement or punish boredom. It has its own brutal logic, and that logic is about to teach both traders very different lessons about what courage actually costs. What happens inside Dave's brain when he wins big is fascinating and terrifying. Research from Cambridge University found that when traders experience large wins, their brains flood with dopamine at levels similar to cocaine users. This isn't metaphorical. This is literal neurochemical addiction happening in real time. Here's the brutal part. That dopamine hit doesn't come from making money. It comes from taking risk. The bigger the risk, the bigger the chemical reward, regardless of the outcome. Dave's brain is literally training itself to crave larger and larger position sizes, not because they're more profitable, but because they trigger more intense neurochemical responses. Meanwhile, Emma's brain operates in a completely different chemical environment. Studies at the University of California measured cortisol and testosterone levels in conservative versus aggressive traders. The aggressive traders showed massive hormonal swings. Testosterone spikes during wins that impaired their judgment. Cortisol floods during losses that triggered fight or flight responses. Emma's hormonal profile remained remarkably stable. Lower peaks, gentler valleys, consistent decision-making capability throughout the trading day. Her brain wasn't getting hijacked by chemical extremes that compromise rational thinking. But here's what's really happening to Dave over time. Each big win requires a bigger risk to trigger the same dopamine response. It's called tolerance, and it's exactly what happens to drug addicts. The trade that used to excite him with $5,000 at risk now needs $10,000 to feel the same rush. This isn't a character flaw. This is biological adaptation happening against his will. Research from MIT revealed something even more disturbing. Traders who repeatedly experienced large wins and losses showed decreased activity in their prefrontal cortex, the brain region responsible for impulse control and risk assessment. They were literally becoming less capable of making rational decisions over time. Emma's consistent small wins and losses maintained her prefrontal cortex function. Her brain stayed wired for good decision-making instead of being rewired for addiction. What everyone calls cowardice is actually neuroprotection. She's protecting her brain's ability to think clearly by avoiding the chemical extremes that destroy judgment. The market isn't just taking Dave's money. It's rewiring his brain to ensure he'll keep giving it more. Dave risks 5% per trade and feels like a warrior. Emma risks 1% and feels like she's barely participating. Guess who the mathematics favor? Here's what sounds crazy to most traders. The Kelly criterion, developed by a Bell Labs mathematician and proven across decades of research, suggests that optimal position sizing for most trading strategies falls between 0.5% and 2% of account size. Not 5%, not 10%, definitely not the 20% positions that hero traders brag about, but 1% feels insulting, doesn't it? It feels like you're not really trying, like you're too scared to make real money. That feeling is exactly what destroys trading accounts. Your ego wants positions large enough to feel meaningful, but meaningful to your ego usually means devastating to your account. Stanford University studied this phenomenon across 3,000 retail traders. They found that traders using position sizes above 3% of their account experienced a 78% higher failure rate than traders using positions below 2%. Same strategies, same market conditions, dramatically different outcomes based purely on position sizing. Here's what's happening psychologically. When Dave puts $5,000 at risk, his entire nervous system activates. His heart rate increases, his decision-making becomes emotionally charged, he starts hoping instead of thinking. When the trade goes against him, he can't think clearly about cutting losses because the money feels too important to lose. Emma risks $500 per trade. Her nervous system stays calm. She can evaluate the trade objectively because the individual trade outcome doesn't threaten her financial security. She cuts losses easily because $500 isn't worth defending irrationally. But here's the really twisted part. Dave's large position size actually makes him a worse trader because each trade matters so much emotionally, he becomes picky to the point of paralysis. He waits for perfect setups that rarely come because he can't afford to be wrong. Emma's small position size makes her a better trader. Because each individual trade is insignificant, she can take every good setup without fear. She trades her strategy properly instead of trading her emotions. Position sizing isn't just about risk management. It's about preserving the psychological state necessary to execute winning strategies consistently. Dave's down 15% on his position, and he's holding strong. Real traders don't quit. Real traders don't get shaken out by temporary volatility. Real traders have conviction. This is what heroes do, right? Emma's down 1% on her position, and she's already out. Gone. Trade closed. Loss taken. Moving on to the next opportunity. Dave would call this weak. Pathetic. No stomach for the real game. Here's what the mathematics say about heroism. A 15% loss requires an 18% gain just to break even. A 20% loss requires a 25% gain. A 50% loss, the kind hero traders take when they refuse to admit they're wrong, requires a 100% gain to recover. Emma's 1% losses require 1.01% gains to recover. She's back to break even on her next winning trade. University of Chicago research tracked this exact phenomenon across 12,000 retail accounts over 5 years. Traders who held losing positions hoping for recovery had a 62% higher failure rate than traders who cut losses quickly. The mathematics of loss recovery aren't opinions. They're brutal facts. But here's what's really happening psychologically. When Dave refuses to cut his 15% loss, he's not being brave. He's being trapped by something called loss aversion bias. His brain literally cannot process taking a large loss because it feels like admitting failure. So he holds and hopes and prays and checks his position every 30 minutes and loses sleep and snaps at his family because he's stressed about money. This isn't courage. This is psychological torture that he's inflicting on himself. Emma takes her 1% loss and goes about her day normally. Her brain doesn't interpret a 1% loss as failure because it isn't significant enough to trigger emotional defense mechanisms. She can think clearly about her next trade instead of being emotionally hijacked by her current loss. The market doesn't care about your conviction. It doesn't reward stubbornness. It doesn't respect your refusal to admit you're wrong. It just takes more money from you while you prove how tough you are. Quick stops aren't cowardice. They're intelligence. Dave's having an incredible month, up 30% in 3 weeks. His Twitter followers are going crazy. The screenshots are getting hundreds of likes. He feels like he's finally figured out this trading thing. This is what real wealth building looks like, right? Emma's having a typical month, up 2%. Boring. Unremarkable. Nothing worth posting about. Her family asks how trading is going and she just shrugs. 2% doesn't feel like progress. Here's what neither of them understands about mathematics. Dave's 30% month will be followed by a negative 20% month, then up 15%, then down 25%. The volatility that creates his exciting gains also creates devastating losses that destroy compound growth. Over 12 months, Dave's roller coaster averages out to maybe 8% annual returns. Some years he's up 40%, other years he's down 30%. The emotional highs and lows feel like he's crushing it, but compound interest hates volatility. Emma's boring 2% per month compounds to 26.8% annually, every single year. No drama, no excitement, no Twitter screenshots, just relentless mathematical progression that quietly demolishes every heroic trader's returns over time. Researchers at Vanguard studied this exact phenomenon across retirement accounts. They found that consistent moderate returns outperformed volatile high returns in 91% of cases over 10-year periods. Boring wins. Excitement loses. But here's what's really happening psychologically. Dave's emotional roller coaster makes it impossible to think long-term. He's either celebrating or panicking, never calculating. He doesn't see the compound effect because he's too busy reacting to daily fluctuations. Emma's steady progress allows her to think in years and decades. She can see her wealth building predictably because there's no emotional noise drowning out the signal. She's not getting dopamine hits from trading. She's getting satisfaction from watching numbers grow consistently. The really brutal part? After 5 years, Emma's boring compound returns have created more wealth than Dave's exciting heroics. While Dave is still posting screenshots and hoping for the big month that will change everything, Emma is quietly building generational wealth through the most boring strategy imaginable. Compound interest rewards patience, punishes volatility, and absolutely loves cowardly traders. Walk into Jane Street's trading floor and you know what you'll see? Traders who look terrified of losing money. They risk tiny fractions of their capital per trade. They have stop losses on everything. They close positions at the first sign of trouble. By retail standards, they're complete cowards. These cowards generate over $8 billion in annual revenue. Citadel, one of the most successful hedge funds in history, has internal risk management rules that would make retail hero traders laugh. Position limits so conservative that individual traders can barely move the needle on daily P&L. Stop loss requirements that automatically close trades before they can become meaningful losses. Their founder, Ken Griffin, became worth over $30 billion by being absolutely terrified of big losses. Here's what professional firms actually look for when hiring traders. They don't want risk takers. They want risk managers. They don't hire for confidence. They hire for paranoia. They specifically screen out candidates who talk about big wins wins or show excitement about taking large positions. S&B Capital, one of the most respected prop trading firms, has a saying that every new trader learns on day one. Your job isn't to make money. Your job is to not lose money. If you don't lose money, the profits take care of themselves. This sounds like coward talk to retail traders obsessed with crushing it and making bank. But SMB's traders consistently outperform retail traders by massive margins because they've been trained to think like institutional cowards. Renaissance Technologies, arguably the most successful quantitative fund ever created, generates average annual returns of 35%. You know what their maximum position size is on any single trade? Less than 0.5% of their portfolio? They're so terrified of individual trade risk that they spread billions across thousands of tiny positions. These firms understand something that retail traders don't. The market is not impressed by your courage. It doesn't reward your conviction. It doesn't care about your confidence. The market only respects one thing: your ability to preserve capital while other people destroy theirs. Professional traders aren't heroes. They're professional cowards. And that's exactly why they're the ones managing hundreds of billions, while retail heroes blow up $50,000 accounts posting screenshots on social media. Dave posts a screenshot of his $10,000 day and gets 400 likes, 50 comments, and 12 new followers. The algorithm loves it. High engagement, emotional content, aspirational lifestyle. This is what trading success looks like, right? Emma doesn't post anything because she made $230 today. Who's going to like that? Who's going to share a screenshot of such a boring, insignificant gain? The algorithm would bury it anyway. Here's what's creating the perfect deception. Social media algorithms are designed to promote extreme content because extreme content generates engagement. Massive wins get shared. Steady gains get ignored. The platforms are literally programming you to believe that success looks dramatic. But here's what you're not seeing. 3 months later, Dave's account is down 60% from his peak, but he's not posting those screenshots. The algorithm doesn't promote loss porn unless it's packaged as motivational comeback content. His failure is invisible. Meanwhile, Emma's boring account has grown 18% over the same 3 months, but nobody knows because steady success doesn't generate clicks, shares, or followers. Her success is completely invisible to everyone except her bank account. YouTube and Instagram are flooded with traders selling courses based on their supposed success. You know what they all have in common? Dramatic stories, massive position sizes, life-changing wins, hero narratives that make great marketing material. You know what you never see? Successful traders selling courses about making 1% per month consistently for 5 years. That story doesn't sell because it sounds boring. It doesn't trigger the get-rich-quick psychological buttons that make people buy courses. This creates a massive selection bias. The traders you see and learn from are the ones with the most dramatic stories, not the ones with the best results. It's like learning about business from lottery winners instead of successful entrepreneurs. The really insidious part? Every new trader enters the market thinking heroic trading is normal because that's all they see. They don't know that the successful traders exist because the successful traders are invisible. Social media has created a world where failure looks like success and success looks like failure. 2 years later, here's what happened to our hero and our coward. Dave's account tells a story that every social media follower predicted. Month 3, he hit his peak, up 97% from his starting 50,000. Screenshots everywhere. Followers begging for his strategy. He felt invincible. Month 6, he was back to break even. Month 9, down 40%. Month 12, down 68%. Month 18, account blown. $16,000 left from his original $50,000 stake. But here's the really devastating part. Dave borrowed $20,000 to keep trading because he knew his system worked. Month 24, that money was gone too. He's now working overtime at his day job trying to pay back loans he took to fund his heroic trading career. Emma's story is the opposite of dramatic. Month 3, up 6%. Month 6, up 12%. Month 9, up 19%. Month 12, up 27%. No screenshots, no followers, no excitement. Month 24, Emma's original 50,000 has become 78,000. Boring, steady, unstoppable compound growth that nobody noticed except her accountant. But the psychological difference is even more dramatic than the financial difference. Dave can't sleep properly. He checks his old trading account obsessively, even though it's empty. He's developed anxiety around money that affects his marriage, his work performance, his entire relationship with financial security. Emma sleeps fine. Trading is now just another income source that quietly grows her wealth without dominating her thoughts or disrupting her life. She's actually reduced her position sizes as her account grew because she's more interested in preserving wealth than growing it aggressively. Dave's family asks him to stop talking about trading. Emma's family asks her to manage some of their retirement savings. Here's what nobody talks about in trading education. The psychological damage of heroic trading extends far beyond your account balance. It destroys your relationship with money, your family's financial security, and your own mental health. Emma's cowardly approach approach didn't just preserve her capital, it preserved her sanity, her relationships, and her future. So here's your choice. You can keep chasing the hero trader mythology that's designed to separate you from your money, or you can embrace what actually works. You can choose exciting poverty or boring wealth. Let's be clear about what embracing your inner coward actually means. It means risking 1% or less per trade, even when it feels pathetically small. It means cutting losses at predetermined levels, even when your gut says the trade will turn around. It means sitting in cash for weeks when good setups aren't available, even when action addiction is screaming at you to trade something, anything. It means accepting that wealth building looks boring from the outside. No screenshots worth sharing, no followers asking for your secrets, no dramatic comeback stories, just mathematical precision applied consistently over time. Are there exceptions? Of course. If you're position trading on monthly charts with clear technical levels and huge asymmetric risk-reward opportunities, wider stops and bigger positions might make sense. If you're managing hundreds of millions and can afford team-based risk management, different rules apply. But here's the brutal reality. 95% of retail traders aren't in those situations. They're just regular people with regular accounts trying to build wealth through trading. And for regular people, cowardly trading isn't just superior to heroic trading. It's the only approach that doesn't end in financial destruction. The market is offering you a choice every single day. You can feed your ego with exciting positions that feel important, or you can feed your bank account with boring positions that compound wealth. Professional traders made this choice long ago. They chose boring wealth. They chose to look like cowards while building fortunes. They chose mathematical precision over emotional excitement. The question is whether you're intelligent enough to make the same choice, or whether you're going to keep believing that markets reward heroes instead of slaughtering them. Because make no mistake, the market doesn't care about your courage. It only cares about your money. And it's very, very good at taking money from heroes while quietly rewarding cowards. Choose wisely.